And welcome back, everyone, to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the main man of the half hour, AJ Brown. Good morning, AJ.
Today it's Babyface Brown.
Babyface Brown in the house.
That's right, Babyface Brown. I got my face all shaved up and keeping it clean, ready to
Yep.
attack the markets today.
Today is January 21st. Wow, we're almost through the first month of January.
Time
And I,
flies.
I, I
Time
feel like
flies.
I feel like today's kind of a more exciting Friday than usual. We got a lot in the news.
Oh my goodness! You see all these very popular stocks selling off today.
The entire market is selling off and kind of rebounding, kind of trying to decide where it wants to go. What do you make of it?
Well, I think the writing is on the wall, actually. Let's just think about it not from a technical perspective or any sort of fundamental perspective, but let's just think about it from, you know, just common sense perspective. What's happening? Well, we finally are getting a break in some of the big cities from this virus, right? The Omicron variant seems to be killing itself off, or getting everybody infected, and everybody's building up immunity to it. And so already people are thinking about the future, right? And so they're thinking about getting out. They got cabin fever for 2 years now. So they're thinking about getting out. And that means they don't want to stay at home riding their Pelotons. They don't want to be watching Netflix anymore. They want to go out. And so things are going to change. And for, investors, and I don't think the top end investors are thinking this way. I think it's the retail investors, folks that jumped in 2021, for them to think that they can continue to grow the same way they did given different circumstances. It's like you're not looking around, right?
Yeah, and you hit two stocks that are in the news today. Maybe not for those specific reasons, but Netflix is getting hammered. Peloton is getting hammered, both for two different reasons.
Yeah. You know, I really think there's going to be a sentiment change. You got the combination of COVID giving us this additional hit and now kind of in theory retracing, but also you've got inflation. And then you've also got what the Fed is announcing they're going to do, tightening up money supply. In addition to that, you've got, all these bubbles. There's a bubble in the market, and there's a bubble in real estate. There's a bubble in commodities. I mean, right now oil is going through the roof and people are getting excited about oil again. Um, the writing seems to be on the wall. I think one of the things I always tell my folks in my program is you can't keep trying to meet the same patterns, or if you're not paying attention to the pattern first. In other words, it's all about first and primary pattern recognition, and then it's about pattern utilization. If you keep trying to do the same thing when the world around you changes, I mean, you can run into a whole heck of a lot of trouble.
Yeah, and I kept reading articles this week about bubbles, and the experts were saying the same thing, that there's these bubbles in these different markets. And so we, as educated investors, traders, the first thing that came to mind for me was, wow, if we know that something like this is on the horizon, what can we do to take advantage of it? Because a good trader can make money on the way up and on the way
On the way
down. and
down,
and I kept thinking options, options, options. So I'm assuming there's some plays, but if someone is looking to take advantage of this, options is a great tool to do that.
absolutely. In fact, you always hear this phrase that the bull climbs up the stairs and the bear jumps out the window. And that means that when people are investing into things that they perceive as risky, like the stock market or the real estate market, they are very slow to release that money from savings. And as they build up confidence, they put more. And so the bull climbs up the stairs. And then when the proverbial poop starts to hit the fan, they're not slow to take that money back out. They're like, ah, and they pull all their money out and put it right back into that jar buried in the backyard or into their mattress. And so the bear takes the market out the window. When you are trading options and can be on the right side or the correct side of that equation, I mean, that's going to allow you to make money in short order if you know how to do it. In fact, let me share this slide. This is the slide that I share in the beginning of a lot of my presentations. Whenever I'm giving a live presentation, I just want to review it for everybody who's on the line. I always say, listen, there's always a lot of uncertainty, especially right now with what's happening in the world. And then I say, but what's happening in the markets, if played right, can set you up for months, if not years to come. Because, one of the things I'm seeing all these headlines of these experts, and they're talking about like $35 trillion of wealth being able to, disappearing when these bubbles burst. That's not true. The markets, whether it's real estate, whether it's stocks, commodities, options, futures, money and wealth is not destroyed there. It simply goes from one hand to the other. So if you know what you're doing, right? Here, money is not created or destroyed in the markets. It simply moves from one person's hands to another. And so the key is making sure you're on the right side of the equation.
Yeah, and so I feel like maybe we should pull up this chart because we've been looking at this the previous episodes going into the new year, and we were kind of identifying a bit of a wedge setup there, but it looks like we broke down to the downside.
It's absolutely true. So last week I was all worried. I was saying, hey, we just pulled back into this wedge, and that means a lot of uncertainty. And until we pop out of this wedge, I'm a little bit worried to be selling into February options, because every time you sell options, you put yourself into a position where you're under an obligation until that expiration date, or until you go ahead and remove that obligation by buying back what you sold, right? So that's something you got to remember when you're in options, right? Whenever you sell an option, you're under an obligation. That's the whole theory behind the contract. And so I didn't want to get under any obligations knowing that this wedge was happening. This thing right here, let me go ahead and highlight it for what I was talking about last week. This guy right here, because usually when you form into a wedge, at some point something happens either to the top or the bottom. Well, look at what happened. It went to the bottom. Now that we've broken out, the question is this a true reversal? Let me go ahead and zoom out a little bit here, because I want to just show you this is actually very significant and why we're hearing a lot of news headlines. If you look over the last 2 years, since the initial scare around the first COVID piece outbreak, the market has been clearly on an uptrend, and this ascending level of support has held out. This is the first time that we're seeing weakness. And so people have to remember that whatever trend, whether it be a trend in the upward direction or a trend in the downward direction or a trend in the horizontal direction, they're not really called a trend until you have a test of the top and the bottom, at least 2 tests of each. So if you have 1 test, 2 test, and 1 test, 2 test, then you start calling this a trend. So what we're waiting for here is, will it bottom, and then where will it top, bottom, top? And if we get something like this, we can say that we're now on a sell-off. It's too soon to tell what's happening, but what we do know is that this current trend is broken.
Yeah, and I'm looking at the chart here, and that 4400 level is looking like a solid support that we'll probably want to keep an eye on in the coming weeks, because that may be a significant point to determine if it'll move back up or if we're going to be heading back down for a couple weeks.
Absolutely. In fact, on this, once a month, SIP, we have this cool call where we invite Paul. And so for folks that are haven't been are just like finding me right now, you need to click on the subscribe button to wherever you're listening to this video podcast. And you need to, turn on your notifications, because periodically we do a little partnership with Paul. And Paul's a technician beyond belief. And he said it this past Tuesday on his call with me that 4,400 was the next, horizontal level of support that we need to be looking out for. And that's going to tell us a lot about the markets, right? So we're going to be watching for 4,400 on the S&P 500.
So we've got this breakout to the downside, but also, if I'm not wrong, today is expirations Friday, right?
Today is options expiration Friday. So I do have my portfolio. Why don't we take a minute and take a look at what's been going on with my portfolio? So last time we featured my portfolio, you saw I had positions on both Mattel and Pulte Homes. Since then, we've added positions on Ruth and Wendy's, Ruth Steakhouse. So we'll start with Mattel. Now, Mattel, we actually were going in the short direction on. So let me switch hats for one quick second. I want to just get clear with everybody on terminology that I use. And I try to use the universal terminology that other people use, but I just want to, when we have a trend, so let me go ahead and again pull my marker out. When we have a trend, whether it be an uptrend or a downtrend, whenever you're going in the direction of the trend, I'm going to be calling that range expansion. So if I'm moving in the direction of the trend, that's range expansion. And whenever I'm moving against the trend, I'm going to be calling that range contraction. Now, if you're in a horizontal channel, that's a little bit harder to decide, right? But if you're doing some sort of trading strategy, whatever your step one, whatever you initially get into, if you go long on your horizontal, then range expansion is in the direction of your initial trade. And then every time it goes against that initial trade, you're in range contraction. And then range expansion, range contraction. So if the first trade you did horizontal channel is shorting, like we did with Mattel, range expansion is going to be in the downward direction, and range contraction is going to be in against that initial trade. And so our initial trade on Mattel was in the shorting direction, or to make money on Mattel going down. So let's pull up Mattel. And you can see that Mattel over time here, I'm still looking at a 2-year daily chart, has had a slightly down direction anyway. So that kind of makes sense. I'm going to shrink us down now, so we're looking more at like 6 months. And so last time we were there, we saw that on November 18th, we shorted some shares of Mattel. And then when we got to the bottom of where we were going to move, which was December 23rd, about a month later, and started to contract, go against that trade, we created a trade zone with a sold put down at $20 and a long call at $23. So if you could imagine it, what we wound up doing is, as going down, we were letting the trade just go down. And that was good because we shorted it. We wanted it to go down. The minute it reversed back up, we set up this pattern where at $20 and $23, we're guaranteed to make money. That trade zone is what options allow us to do that you can't do with any other, trading strategy. And you'll notice that, and you might want to, write this down, guys. We adjust our patterns at times of peace, not at times of war. So, I didn't wait until, for instance, I'm up here and things are getting critical with my break-even price. That's not when I want to put protection on, right? You want to put protection on way before you're doing the act. So the scoop is we had our range contraction, and the minute we got confirmation of range contraction, when things are still peaceful, that's when we put our protection on, and that's when we select a little bit of income by selling our front month put. So we went ahead and sold the 20, put some protection on 23 when things were at peace. And sure enough, we then just recently started to reverse back down. I didn't need my protection anymore because I confirmed that I was now back into a range expansion phase. So with that said, I again adjusted my position. I took my protection off. Let's take a look at the log here. So on January 14th, I didn't need the protection anymore. I had bought that protection for 65 cents and I sold it back when I didn't need it anymore for $1.10. So think about that. For the whole time between December 23rd and January 14th, I was protected, right? I had an insurance policy in hand. But smart me, when I didn't need that insurance policy anymore, I sold it back, and I actually sold it back the way that I selected the options. I sold it back at a nice little profit, right? 65 cents is what I paid for this insurance policy. The whole time I held it, it was doing what it was supposed to be doing. When I didn't need it anymore, I sold it back for $1.10. Now, today's expiration date. We already know that we've got to keep this 50 cents that we made by selling that front month put. So we made 65 cents per share. I'm sorry, we made not 65 cents per share. We made 55 cents per share on rolling out our protection, but we're also going to make 50 cents per share on selling that put. The only question we have based on the end of today is, we get to go on and do this again, or will we get exercised? So we would get exercised if Mattel winds up closing below $20. Doesn't look like that's going to happen. If that doesn't happen, then we're going to do this again on the next little peak. Or if Mattel continues to drop, which it might, we might look for a way to just take advantage of that shorted position. So Mattel is working out really nice. Think about it. If we do get exercise, that means that somebody's going to go ahead and sell us our stock that we're going to return to our broker for $20. We're going to walk away with about 16% ROI. You can see these numbers up here. Depending on how you calculate ROI, 15.3% or 16.5%. About 16% ROI if we get exercised. If we don't get exercised, we're going to go and, either do this all over again next month, or we'll get rid of Mattel at whatever low price. If it goes down to $19, we'll walk away with about 20% ROI. So we're just playing around with being patient, right? Last night, Mattel closed at 21.63. We locked in about 8% ROI as of last night. Mattel seems to be going lower today. We want it to go low. We're short the position.
So we're just in a waiting period here, and when is the last day of this position in theory that you would need to get out of it?
So if you think about it, the trade zone that we set up, part of the trade zone, the protective call, is already gone. So there's no limit to the top. That was at $23. It's dissolved. I closed that position. The trade zone to the bottom by the put at $20 is also going to end at the end of trading today. And it's either going to end with it just dissolving, that's called expiring worthless, or it's going to end with my Mattel position closing and me coming in at $20. So those two trades are going to be closed, and I'm going to be left shorted Mattel. And I'm going to be left shorted Mattel at this $23.42 price. So anything that I go lower than $23.42 is pure profit. So the question that comes up is, I'm now shorted Mattel with this new extra high, break-even price, which when we're shorting things, the higher the break-even price, the better. And so the question is Mattel going to start range contracting again? Because if it does, we'll just set a new trade zone for the February expiration. If instead it keeps expanding in the direction, we're just gonna wait until it exhausts this current expansion and just get out of the trade then. So we're just gonna let Mattel profit for us as far as it can.
So basically, if the market, quote unquote, starts to fall and the bubble theories begin to evolve, you could continue to hold this and then profit on the way down.
All the way to 0. And you think about so that, you've got the correlation of the overall market, but you also have Mattel. The toy season's over, right?
Everyone,
So,
yeah,
you know,
everyone's got their toys for
everybody's
the
got their
year.
toys. So if Mattel is going to be swayed by market pressures, it really doesn't have like, hey, holiday season's coming up, prop us up a little bit. That's, another 11 months away. So the scoop is that if the things start pulling Mattel down, we're in a pole position, right? I'm really set up well because of the way I'm trading options to make money on Mattel going down.
Beautiful. So Mattel, fabulous setup, fabulous execution. The other name that you mentioned was Ruth. Where are we at with Ruth
So,
Steakhouse?
okay, let's go to Ruth, and then let's do Ruth and Wendy's, and then let's come back because Pulte Home is a whole nother creature. So if we take a look at Ruth, as soon as we had featured it, I was looking for a initial position to get into, and we were up at the top of our channel, and so again, I decided, and this was actually before the most recent kind of the sky is falling type newscasts coming out of town. Um, I decided that I was going to set up this position to the downside as well. So if we take a look at Ruth, I tried, and this is a rule of thumb for all folks who do this. I always tried to use a back month option. I would rather substitute the underlying symbol with a back month option any day because number one, there's some leverage. But number two, especially when it comes to shorting the market, I can short a market, but I need to have a margin account, right? And then there's all the expenses that go with doing shorting trades and doing things with your broker on margin. If I can instead substitute this shorted stock with a long back month put option, I would do that all day and all night. Problem with Ruth is there was no liquidity. I had orders out there and they weren't getting filled because there was no marketplace for the size of my order. And so I had to go back to shorting the stock. So I did. I shorted 400 shares of stock in our portfolio on January 14th. I wound up getting $20.28. Now, remember, when you short a symbol, what it means is you're selling to open. That means you've borrowed your symbol from your broker. You've shorted the shares. You've collected the cash up front. And now your goal is to buy it back at a lower price so you could return your shares to your broker and keep the difference. That's what shorting is. So I shorted some shares of Ruth, which means that even though I've depicted this as a sideways channel, I'm actually range expansion for me is anytime the symbol is going down the channel. And the minute that this starts to go up the channel, that's when I'm going to set up my trade zone with my options, right? I'm going to go ahead and sell a front month put, and I'm going to buy a protective call. And then the minute that range contraction disappears and I go back into range expansion, I'll go ahead and dissolve these. This guy dissolves away with time, and I'll see if I can do it again. Now, if Ruth ever shoots past this $17.49, $17.50 level, then I'm just going to go ahead and take profit. It doesn't make sense for me to do these option trades. It just makes sense for me to go ahead and buy back Ruth wherever it exhausts its downward movement and just take the profit and move on to another symbol. So that's kind of the ongoing strategy that we talk about in our workshop and what we do day to day.
Is this what we would consider legging into a position where you have the one part and you're kind of waiting for the setup of the others, but if they don't happen and the trade is profitable, then there's only one leg?
That's correct. Legging in
Awesome.
basically means taking a option strategy that has multiple options and doing each option separately at a different date and time. So that's exactly what we're doing here.
But in this example, you're not legging in with the option, you're legging in with the short position.
That's right. So this particular strategy, this is called a covered put. This particular strategy is includes a stock trade. So it includes shorting, which means selling to open some stock, and then the next position that you can do is selling to open your put. That's the covered put strategy. So we're legging in right now by doing step one is shorting the stock. Step two will be shorting the put. And then we go ahead and do the extra. We go ahead and protect this whole trade with a call purchase. So it's a protected covered put, is what we call it. And we're legging in by shorting the stock and selling the put and buying the call on two different dates.
So it looks like the Ruth and the Mattel to the short side is starting to work itself out. Are we also looking for Wendy's to break to the short side? Was that the position on that symbol as well?
Yeah, and what's interesting is Wendy's, and when I'm gonna again, I like to always zoom out. I always feel like one of the biggest problems, especially with traders, is that they don't look past the tip of their nose, like what's happening today. So I always like to look at the bigger picture. And Wendy's has over the last again, since the COVID thing, has been in this nice slightly, and when I say slightly, I mean really slightly. I mean, over the last 18 months, it's maybe appreciated 25 cents, but it is appreciating. And so you would think that what I would want to do is wait for it to bottom and go with that appreciation. Make my, buy either some Wendy's stock or buy some back month call and make my range expansion in this direction. But Wendy's is so kind of mellow and easy to trade. And I started to rationalize because I've been following along with the interest rate hikes. I've been not the hikes, but the news around that. I've been looking at I'm just using common sense here. And I'm thinking about just what's happening here in Washington, D.C., or when I go to my beach house. People have cabin fever. And the first moment that they feel safe, they're going to start going to restaurants. And the last thing they're going to want to do is go to the to go, the drive through for Wendy's, right? Or McDonald's or any of these fast foods that they've been like going to very quickly if they're getting, fast food at all. And so I'm kind of rationalizing that, you know, it makes sense that on these individual stocks that I be in a shorted position. It just makes sense to me. But even if I'm wrong, the scoop is with options, the minute it starts going into range contraction, I'm going to go ahead and set up my trade zone so that I can make money in that zone. And I'm protected above that zone. And I've got a max profit to the bottom of that zone. So it really doesn't matter with options, right? You architect these positions that work no matter what. And people have a hard time grasping that. They're like, well, what if the market goes against you? Well, I've set up a trade zone and I make money anyway, right?
Yeah, and it looks like that bottom zone is what, like 20, 20, 50, $20, something like that.
I haven't set it up yet. So right now, and I apologize, I'm all over the place. But with Wendy's, there was enough liquidity, and that was like a godsend for me. And I did 20 contracts, and that's a lot of contracts. I did 20 contracts of the Wendy's back month. So I went all the way out with an expiration date in January of 2023. So I basically got a whole year. and the 30 put strike price. Now, these things are so deep in the money that they're acting like the stock. So if the stock moves $1 down, this put is going to move $1 up. So right now, sometimes it's hard to wrap your mind around, but right now the stock is trading around $22. If it goes to $21, then this put will go from 780 to 880. They're dollar for dollar, but they're opposite, right?
Beautiful.
Yeah. So I'm in this thing, and the more that Wendy's goes down, the more that this put is going to go up in price. And I'm going to just watch that now, and I'm going to see how far it goes down. If it goes down and passes this line of support that I have here at $20.50, and even goes down a little bit further, maybe 19, I'm going to just let it go down. And I'm going to go ahead, and when I'm ready, I'll buy back. I won't buy back. I'll sell that put and take whatever profit I get, right? But if it starts to what we call range contraction, if it hits this level of support like it has countless times over the last 18 months, if it hits it and starts to contract, the minute it does that, and I have confirmation that it's heading back up in the channel, that's when I go ahead and buy my protective call, and I sell my shorted put, and I create this zone that I call the trade zone, and that's just going to accrue profit the whole time that I'm in that zone. And that's the whole strategy, because now if I go out of the zone in either direction, I'm guaranteed, set statistics during this most sensitive time where I'm contracting against my initial position. And again, if I turn into range expansion going in the direction of my initial position, then all of this stuff dissolves. This one dissolves with time. This one dissolves because I go ahead and roll it out. And every time it's going in the direction I want it to, I just let it go. And every time it's not, I collect premium by setting up that trade zone.
So question, what are you going to be looking at for this bottoming confirmation? And I know we've looked at some of the other tools, but I know that you use a couple setups to help define that.
And I got to tell you, there is, after meeting with Paul, and I can't stress enough that folks should subscribe to our channel, because Paul and I are scheduling another call next February. So make sure you hit that subscribe button and you turn on your notifications. In fact, why don't you just go ahead and like what you're hearing right now? That's going to help us get our message out to more people. But I like to use the MACDs. He mentioned using the MACDs when he was discussing his sideways channeling strategies. I use the fast MACD. This is something that I sat down with the guys over at the MACD Institute. It's a father and son team who the father came up with the MACD years ago, and it's one of the indicators that I say that's been around for quite a while. I like using the fast MACD to tell me when the bottom is. I've also been paying a lot of attention to the quantitative analysis side. I've been looking at the NASDAQ level 4, so I'll see, quantitatively if all of a sudden, the big money investors out there start doing some buying down here. So that's going to be guiding me as to where that bottom is and what the timing is going to be for setting up that trade zone, or just taking the profit and moving on to another trade.
Yeah, and usually you look for like a day close confirmation, something like that.
Exactly. And, that's what our whole program is all about. I mean, for folks that are interested, we have a workshop that we do daily. It's a pre-recorded webinar that folks should join in on. There's enough information in there that, and it's complimentary, no cost. There's enough information in that webinar to make you dangerous. And then if you're interested in trading with us, you should join our program, right? We meet every Thursday and discuss, positions. I'm talking about the whole crew. We have over 400 folks in our program. We usually on any given Thursday, have 100 or so people on the line. They throw symbols at us, and we pick the best of the best, and we plan those symbols out for the next upcoming weeks so that we have, a position that we can go at. You guys should join that program for sure.
Yeah, and the link is in the chat. So if anybody wants to learn how they can go ahead and get in there, go ahead and hit that link, sign up. You'll get the notifications on what to do next. And our last symbol of the day is going to be Pulte Home. And we've been talking about this one for a few weeks. Looks like
Yeah.
it's consolidating there a bit. It's getting like sloppy chop.
Yeah. So here's a case where I bought some shares of Pulte Home. I bought these just recently, December 21st, about a month ago. And we waited, and it was just a short amount of time. We waited for the new year. So we legged in by buying some stock. And then on January 3rd, we got hints of range contraction. So that's when we set up this trade zone between $55 and $60. So let's take a look at that on the chart. In fact, let me go ahead and clear away some of this junk here that I use to decide what strike prices I want. That's a whole science as well that we talk about. Yeah, you can see that similar to the S&P 500, we're breaking away. Now, we went in the direction of up. We bought stock, so we wanted the price to go up. And the minute it started going back down, we set up our trade zone. And as we said, our trade zone was between $55 and $60. So if we take a look here and we mark $55 and $60 on our screen, here's the 55, and 60 is not even visible. It's up here somewhere. Yep. So I'm in the zone right now. And so you can see that I'm down below the $60, below the $55. That means that my call that I sold with the $60 strike price, it's going to expire worthless. That means that this is going to dissolve today. At the end of the day, I'm not going to have this boundary anymore of my trade zone that I set up. That's going to dissolve. And I'm going to get to keep the money that I made by creating that boundary. It's just going to get credited to my account, reduce my cost basis on buying the stock. And I've still got this position in place. This is my protective put. Now, on the Mattel, I had a position up here, and as soon as I was no longer in range contraction, I got rid of the protection. You can see here that I'm still in range contraction. I'm still going against my direction. So I'm letting that protective put appreciate as far as it can. And there might become a point here, especially after today, when I no longer have this sold call, where I might sell back the stock and allow that protective put to keep going up. Right now, the protective put is increasing dollar for dollar as the stock is decreasing. So my risk pretty much has stopped completely. But there might be a point here that we evaluate on Monday where we decide to sell our Pulte stock and allow that protective put to continue to go down. Now, I see a little bit of, maybe a bottom forming here. So if that happens, then I'm just going to stay tight. So I'm going to wait to see what happens, because you can see in previous retracements, when a bottom is formed, Pulte bounces up quite quickly. So if it bounces up and starts to show me that it's bouncing up, well, I won't need the protection anymore. If I join right back into this range expansion phase, I'll sell my protection at a profit. And right now, the protection, let's take a look at what the protection's going for. Let me get rid of some of this chicken scratch. If I look up Pulte Home $55 put expiring April, the $55 put is currently at about $5 as of right this minute. I bought this thing for $3.30. So you can see that my protection is really profiting nicely. Last time I recorded it, it was at $4, but right this minute, it's at $5. Think about the profit I'm making on that. So if Pulte Homes decides to find a little bottom here, like it's done 1, 2, 3, 4 times in the past, then I'll sell that for $5, make a real nice chunk on that protective put, and then I'll see how far Pulte Homes comes back. I may decide to go ahead and just liquidate Pulte Homes, call it a day. Or if it goes up and decides to then contract, I'll set up yet another trade zone. And that's the beauty. I can set up these trade zones, and every month I can collect a profit. And so that's the beauty of these positions. Just keep collecting that income, as long as the pattern behaves. The minute the pattern doesn't behave, you're out of here.
Yeah, the only risk I could see here is if that real estate bubble starts to gain traction. I imagine a lot of the institutions, retailers will look to, get in on some of these real estate names, and Pulte Home seems to be a very popular one that'll just probably take the heat for the overall market.
Well, and that's okay. So, think about it. If that happens, and that might happen even sooner than later, I can get rid of my Pulte stock and I'm left with a put. What do puts do when the price of the stock go down? Puts blow up, just like we saw right now. I bought this protective put at 330. It's currently at $5. If Pulte Home keeps plummeting, that put's going to go to the moon, right? Pulte can go to zero, and I'm going to be fat and happy. I'm on the correct side of the equation.
And what's the expiration on that?
April.
April. So solid 3 months. 3-4
And
months.
it's currently in the money. So it's accruing what we call intrinsic value. You can't take that away with time. So I've got hard dollars on this put, and it's mine. And I just have to either sell it or let it accrue value. So if indeed we start, if the ball keeps rolling on the real estate market and I'm in this protective put, I can go ahead and, sell that stock and just let that put appreciate unfettered. Make sure you're on the right side of the equation. That really is an important part of the whole puzzle. And with options, you can totally do that.
And so these are 4 names that we've been looking at for a couple of weeks. Some one-time positions, some rolling over from month to month as they begin to range bound. And we'll keep an eye on these. If anyone watching has ideas or positions or stocks that they're looking at, feel free to leave a comment, and AJ will go ahead and take a look, see what he thinks. If you haven't checked out the workshop, the link is in the description and in the chat as well. Go ahead and check that out. And with that, I think we'll let the options expiration Friday do its course, and maybe next week. How often are you going to be looking at new symbols, or are we just going to keep working what's been working?
No, now that we see that the market is under some duress, we're going to watch our patterns carefully. And we come up with new symbols every day. We have a screener built into our members portal, and so we're constantly looking at new symbols. We'll have new trades next week that are going to take advantage of the current patterns that are materializing.
Yeah, and we just have a question come up here on another symbol that we've looked at, and that's the CLF. So let me just pull that
Cleveland
up real
Cliffs.
quick. Yeah. Did you sell any premium when CLF rolled over around the center zone?
Yeah. And so CLF has been dipping, and we're depending on whether we're in a long or a short initial position. If you're in a short initial position, you're just going to let that short initial position go as low as it can and then, liquidate. If you're in that long position, more than likely you're going to have your call dissolve worthless right now, and you're going to let your protective put do what it's doing. So the scoop is that CLF seems to be doing exactly what we wanted it to do, whether you're in the top or the bottom position.
Fabulous. All right, AJ, any exciting plans this weekend, my friend?
No, I don't have any plans. I have a little one. She dictates the plans.
The little one is not looking so little anymore, getting bigger by the day. Goodness.
She really is. I mean, and now she's doing things where she's making all kinds of different sounds, and she's being a little bit opinionated, and no, I don't want this. Oh, okay. It's not just, we're getting to the point, this Sunday she'll be 12 weeks old. On January 31st, she'll be 3 months old. And she's no longer, it's no longer a matter of can we keep her alive anymore? Now it's a matter of like, now she's got a personality.
Yeah, and that personality is going to evolve every day.
Yeah, I almost wish she was still a lump.
Yeah, no, you're going to want some of that personality.
Yeah, it's cool. I get to spend mornings with her, and that just melts my heart.
Well, that's good to hear that everything's going well on the family front. Yeah, with that, I think we'll go ahead and close the show out, and we'll look to have anyone, um, anyone new. Please hit that subscribe button, and we'll be back at you next week.
Yeah, just make sure you're on the right side of the equation. 2021 was the year of having retail investors join the market. And it was all these folks that had some disposable income and they were bored, right? And so they got into trading. I think 2022 is going to show a shakeout. And again, all the headlines are saying that wealth has been destroyed or wealth will be destroyed in this shakeout. It won't really. In fact, it's actually going to bring folks that were into the markets, almost beyond what their knowledge and experience should have brought them. It's going to shake them out, and it's going to bring them back into the level of those folks that don't have the ability to get into the market. So it's almost going to be an equalizing force. But the one thing that keeps happening is those folks that do have the knowledge and experience, that know how to be on the correct side of the equation, they're going to profit big time. So now is the time to get into that options, right? Now is to understand how to be on the correct side of the equation, because that top, small percentage of folks that control the largest amount of wealth in the markets, they're going to profit. All that wealth is going to move their way, and you should have your, cup right there with them.
And with that, everyone, we'll see you next week.
That's right. Babyface Brown signing out.